Hello and welcome to a fresh new episode of Value Investing Decoded. With me now is one of the well-known voices in the mutual fund industry. His fund has given a return of greater than 22% since inception, and he's very passionate about finding sectors and stocks which have high growth and then internally looking at it to buy into his fund and making returns for various number of retail holders that he has. Mahesh, thank you so much for taking out time for us and our viewers. Just at a very basic, can you just tell us about the ideology or the, every fund has, some sort of ideology or philosophy without which, they would not go ahead and look into any stock or any name. What do you look at? I believe growth at a reasonable price is what Birla is looking for.
Yeah, so I think our philosophy when we look at stocks can be summed up into growth at a reasonable price, or GAR philosophy. But essentially, we're looking at three things when you're investing into a stock. A, I think the company which we are looking at, the top line growth for the company should be higher than the average industry growth rate or the average GDP growth rate, because then only it can create a long-term sustainable value. That's the first thing which we look at. Secondly is that the overall return on capital employed has to be higher than a particular threshold level. Normally 15% is the minimum threshold level which one would look at, but higher the better, because companies with higher ROCs we see generally able to create long-term wealth. And we will look at essentially the incremental ROC is what is really of more important to us. And the third important thing is that companies should be able to generate free cash flows over the market cycle or the business cycle. I mean, it can probably few years, okay, the cash flows can be negative because of investment, but over the business cycle, it has to generate free cash flows. And finally, there is certain filter which we have for management quality, okay, which we look at from that lens. It has to meet certain criteria before it becomes an investable stock for us. So these three things are four things, or whatever you can say, are tenets, okay, under which we scrutinize every stock before we invest into.
Right. So, we'll touch upon each one of them and try to understand what's the philosophy further into that. But can you just tell us why value investing is so interesting? Some people say it's, just about contra buying, buying low, selling high. Is it just that, or it is much more than it?
So I think for us, value investing is not just buying contra or just buying cheap stocks or low PE stocks or low price to book value. I think when we say value investing is for us to look at, find what is the intrinsic value of a company based on our assessment about the future growth of that company and discounting that, and seeing whether there is a distortion between the value which is there in the stock and the current market price. I mean, that's the way we look at value investing, and that opens up a lot of possibilities investing in the Indian market, because purely from a low PE, low price to back value, they do well at times, okay, in certain phases. But for sustainable wealth creation, I think we should be able to really capture the future earnings potential of the company and see that, and whether you're buying a stock at a reasonable price.
Right. Just for our viewers, a lot of our viewers would be trying to research, trying to do their own research, maybe doing some, how should they start about, trying to identify a company? Maybe if you could give an example that, how did you start with X company which did very well for your company?
So I think there are various ways in which you would like to identify a company. There, one approach could be looking at kind of a top-down approach, looking at which are the sectors or areas, okay, which have a big opportunity, looking at the bigger picture. And it could be because of increase in penetration, okay, which could drive growth in a particular sector. It could be, for example, increase in the overall technology or a big change, okay, which could open up an opportunity. And so looking at the big picture sectors, okay, where we think that the growth, the opportunity, the pie can be bigger over the next 5 years at least time frame one would look at. And then drilling it down to look at companies within that sector which have a competitive advantage or have the right to win in that sector. That could come either in because of a better technology, some cost competitiveness, or it could come in because of strong brands. So identify those companies, and then I think if you get these two things right, I think you will get a winner at your hand. I mean, and valuation will be the third thing which you would obviously look at. But that's not such an important parameter when you're looking at investing a stock from a slightly longer term perspective.
Right. So, let's drill down into both of these parameters. How do you start about looking at an industry? Say, if you want to look at X industries, what can you look? Look at the industry body targets, look at the company's interviews, company's con calls, and try and find out what's the growth rate going to be like?
So I think for the industry, you need to look at the segment, okay, what it is catering to, and how is the end segment growing, and what are the key drivers for that growth, and how sustainable are those growth drivers, is what one would like. For example, if you look at the banking industry in India, what is the key driver for that growth? It's going to be your nominal GDP growth, the underpenetration, okay, which is there in the sector. Especially within banking, again, you would then drill down into the retail banking, for example, where the underpenetration is still very low. If you look at the leverage at the individual level is still very small. A lot of customers are still not banked. So obviously, it gives a big opportunity and space for the sector to grow secularly for many years. So I think all these factors is what one will look at when you're trying to really assess the potential for an industry to grow and grow at a faster pace than the broader GDP growth.
Right. For our retail viewers, it may be difficult, for them to identify a lot of sectors. Can one look at the individual, how their habits are changing or how the surrounding is changing? What's the sort of lifestyle change, and then probably identify these sectors? Is that something which can be done?
So that's another way of looking at it. I mean, you can look at the user trends. I mean, demographics, like India has been a large consuming economy, and there's a lot of underpenetration which is there. Per capita income is still at a very low level, and I think as the per capita increases, there is a potential for certain goods and services, okay, where which can grow, and you can always draw parallels looking at some of the other markets which have gone through a similar phase at what stage we are in terms of our evolution, and that's a good benchmark to start off with. I mean, look at, for example, China, for example, what China was, say, around 15 years back in certain sectors, and what potential some of those things can happen over the next 10 years. I think that's one way to start off trying to look at where the penetration levels are, and then comparing with certain other economies which were at similar level and what they have reached over the next 10 years.
So that's the first part. We've identified the industry. Say if the industry has 5 players, 6 players, how should one, approach towards the players? Should one stick to the number 1, number 2 player? Because history has shown that whenever an industry does well, larger players tend to do better.
So I think once you have made the top-down call, really, got it right, then I think half the battle is won, I would say. I mean, when there's a tailwind in a particular sector, we see that everybody does well. But obviously, the bigger pie will be taken by a few players within that industry, and initially probably the winners might not be very clear who's going to really come up in the top 3. But I think there are a couple of characteristics which one needs to look at into the companies. Whether they are continuously innovating in that space, trying to be at the forefront, whether it is in terms of cost competitiveness, okay, which could be the advantage. It could be a distribution franchise, okay, it could be service network, okay, which could be more relevant, say, for example, in a consumer durable industry, or it could be trying to invest into brand building, which would help them to get a better pricing power. So I think those are the things which one needs to identify and really help us to really rank the companies within the sector on those parameters to identify which would eventually be the winners in that sector.
So, let's just take an example of Britannia. You own it. So, assuming you expect that a lot of unorganized sector would go away in this sector, and the growth rate of organized sectors would do well. Britannia being one of the top players, one of the best brands, that's how you approach towards that company before investing into it?
So, yeah, I mean, the potential in a stock like Britannia, for example, okay, when we look at the stock around 3.5 years back, was always there. I mean, it was a segment where the margins were very low. If you look at compared to the other industry, the margins were very low at around 6% or so. The unorganized sector was still pretty large, so there was a lot of room for the company to grow if they had the right pricing and the right products to grow and invest into the brands. But I think more importantly also, like in a case, there could be a management change, okay, which can again reinvigorate the company. and try to really get the true potential out of that. And that's what some changes which happen, which one is to identify. The same thing happened in Britannia, okay, when there was a management change, and there was a clear approach in terms of trying to move towards brand extension, moving up the value chain, premiumization, and try to draw cost efficiencies and improve margins. So I think all these things, the potential always there, but it need to be triggered, and a management change brought that. And that's where I think when you have a case where the market size is expanding, you can grow that market at a faster pace, margins are improving, ROCs are improving, automatically you have a winner at your hand, and the multiples also tend to really follow that. I mean, you see a big re-rating, and that's where the multi-baggers were created in the marketplace.
So, see, Britannia is a very clear leader. They have been investing a lot in their brand building. But, if we take example of a bank, as you said that, banking would grow greater than GDP, and it has done very well. Can you just tell us, there are so many players. How should one identify? Should one look at history of the last 10 years, which banks have done well, what has been, their previous performance? How should one start to identify these companies?
So again, I mean, the same principle, okay, what you will look at in any other stock. So you will look at the franchise of the bank, okay, first is on the asset side, okay, what kind of franchise they have compared to this thing, which will enable...
No, I actually meant to ask that, how many years of history should one study for this?
So I think wherever the history is available, because you're not fortunate enough in certain companies, which suppose if a new company comes with IPO, but normally I think we would look at the last 10 years. I mean, you have all the data which is available is what you will look at to look at in terms of how they're able to improve on various parameters which are critical to that industry, how they're able to gain market share and look at it. More emphasis though would be put on the last 5 years and 3 years, but I think 5 years has at least a time frame which one should look at if one has the data to analyze in terms of how the change has been, a trajectory. For example, in a case like a bank which you mentioned earlier, okay, how they are able to improve on the return on assets, for example. Okay, what has been the how the cost income ratio has been moving. There is a continuous improvement which is there because of the scale and size. Is something which you will monitor and try to see whether the company is being able to move in the right direction. But also said that, I mean, you need to identify what is the key competitive advantage. Each company has certain advantage, and how they're able to leverage that to generate better returns.
Right. So, say if we take the example of Yes Bank, which you have within your portfolio, it's a well-discovered company. Still you own a lot of Yes Bank. Just not telling us about the future. What drove the thought to still keep it? Because, we always keep getting this various commentary that it's one of the most expensive bank, it's valued very expensively. So still, why are we holding on to it?
So, I mean, just since you talked about this particular company, again, this is a compare. I mean, it again kind of a top-down view. I mean, our view has been that the private sector banks will continue to take market share. So that's a space which we like, where we see them growing at a faster clip than the broader credit growth rate. And that's a trend which we've seen for the last 10 years or so, and I think will continue for the next 10 years or so. So that's the one top-down bit which helps us to really say that we want to be in that space. Now, within that, a stock like Yes Bank, for example, has been, they have been, I mean, the base has been, this size has been very suitable for them to really grow at, say, around 25-30% kind of a growth rate. And the opportunity has always been there. I mean, earlier it was in the wholesale banking, in the corporate banking in a big way. And they have been able to manage the risk pretty well. The underwriting standards have been pretty good. And where at a time when we have seen stress on asset quality, they have been able to navigate that much better. And also a lot of focus on fee income, the other income, which helps you to really shore up your ROAs and ROEs. Because in the banking system, I think we look at ROEs in a big way, because that what really enables you to sustain a growth rate at a higher rate. And also the transition of the bank in terms of trying to build its liability franchise, the CASA ratio, and then build a retail book, which will change and re-rate the company. So the stock multiples, it was never the most expensive stock in the private sector bank. It was much cheaper because it was slightly weaker on the liability franchise. But as it starts to correct that, obviously there is a re-rating what we have seen in the stock, but it's ultimately the higher growth, profitable growth is what creates value, and what we've seen that in the last few years.